We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke, Britton Financial Partners.
We've got JT here with us today from InvestSense, getting our market update for the quarter. So JT, it's been an interesting time. I think we say that every time, but again, another interesting quarter and an interesting couple of weeks. We were just saying before we started recording, I think 2 weeks ago I spoke to you and you said might be some interesting times ahead, and you were on the money. So let's unpack that a little bit.
Thanks, Ben, for having me again, and really glad to be here. Yeah, so look, there's been the beginning of August, quite a bit more volatility than we used to. We can probably say now that it was more of a blip than anything else, but happy to kind of walk through a little bit of the lead up to that and what happened at the beginning of August. In the lead up to that, like if I can maybe sum up the last few years, really, it's that we've had COVID. Immediately during COVID, there was anticipation that there would be a recession because of the pandemic. And therefore, government here in Australia and in most of the developed world stepped in to provide stimulus, right? And make sure that the economy doesn't stay in a recession for too long. That stimulus came in the form of a fiscal spend and also monetary, so reducing interest rates. That was successful, in fact, very successful, more successful than anticipated. We avoided a recession completely. What it created then, that overspending created an inflation problem. And that's the problem that we've had to deal with since then in 2021, 22, and 23. Now, all of what the central banks essentially have been trying to do over that period of time is reduce inflation, take it under control, but try not to crash the economy in the process, right? You got to slow down the economy, but not too much that you don't create a recession. And that's a very difficult exercise to get exactly right. And markets generally have come to call that the soft landing, right? You're going to land on the inflation and reduce economic activity a little bit, but not too much. And that was very difficult. Up until this point, I'd say by and large, they've been pretty successful at doing that. We've seen inflation come down and actually economic growth has remained quite steady. And we've reached, that point in time at the end of July where almost ready to say mission accomplished. And what that means, what mission accomplished means is that the central bank can now start slowly reducing rates. You don't need to maintain rates that high because there's less of an inflation problem. And that is really good news for everybody. All investors, bond investors, equity investors, low interest rates benefit everyone in the economy generally. So that was kind of all the good news that was building up really for the last 18 months, but maybe even more so during the month of July. And then what happened at the beginning of August is we got one data point that suggested that actually we may have a bit more of a recession risk than we anticipated. So inflation is fine, all tick, but actually unemployment started picking up in the US more than expected. When unemployment picks up, it's usually a sure sign that the economy is weakening, and that was happening faster than expected. So the market started worrying about a recession, and hence why we got that reaction. Now, one of the things that we've discussed is the reaction disproportionate to the news item. And to some extent, yes. And as we've discussed in our catch up 2 weeks ago, we spent a bit of time on that, is the difficulty in market analysis is understand what is already priced in. Where are the expectations? And if all the good news is already priced in, expectations are fairly high, then even a small disappointment can cause kind of an outsized effect. And that, in a nutshell, is what we saw at the beginning of August.
Yeah, and I think maybe because we'd been on had been a good run for the markets, and most people's portfolios still, if you look at a 12-month return, is incredibly strong. I think, again, it's probably a little bit of the media love to jump on a negative story as well, because I flicked on the news on the Monday morning and I thought the whole world had melted down for a little while there. But in reality, it was probably had taken maybe a fortnight or a month's worth of gains back off the market. We're still in a very, very strong position. And if you look at those portfolio graphs across the 12-month period, they were trending up beautifully, and then just a little dip just right at the end. And then I think everything sort of restored order again pretty quickly. But I suppose people are sensitive, aren't they? Like, we're probably more sensitive to one negative indicator than we've ever been before, and we'll probably talk about it shortly. But if someone doesn't quite meet a positive expectation or beat their expectation, how negative that can be perceived as well. It's a different time to what we've had previously.
Yeah, absolutely. And that's very much a function of valuations being high. So that's a bit of a technical term, but what it means is as investors in shares, we're asked to pay a fairly high price relative to fundamentals and relative to what we normally pay for shares. And that means, again, that a lot of good news is priced in. And when there is a little bit of disappointment, that tends to have an outsized impact. I think you make a good point in relation to putting that back into the context of 1 month, 6 month, 12-month performance. Yes, it was a large move for one day, but in the context of the last 12 months, it was a bit of a blip. And the reassuring thing is that over the next few days and in the kind of week after that, then markets have by and large recovered, if not all of it, and at least more than half of the fall. So there is that period of time for a couple of days where you start wondering, is this the start of something larger? Like, is this the start of a 20, 30% correction? And I think now we can say, well, it wasn't, right? Like, which is not to say that it couldn't happen again tomorrow. But
I'm going to hold you to that. It definitely wasn't. It definitely isn't the beginning of doomsday.
Yeah, exactly.
And again, I suppose what we've played in this cycle of too is as soon as that market has a drop, people actually see the opportunity, and then people are starting to pile back. As soon as you get that little drop, people are then putting money back in and going, oh, okay. Very quickly things look okay, and then we sort of start our progression again forwards, which has been as things that look okay. And I suppose again reminding people of the fact that markets are super forward looking. Like, we're looking not about the next 1, 2, 3 months, they're looking months and years ahead of where we are at the moment. And maybe that just a quick note on maybe even the US election coming up, and again talking about pricing things in. I think there's always a bit of a fear with that going on. What does that mean for markets? Well, maybe just some commentary on that and how that's already maybe factored into the market.
Yeah, sure. So there's maybe a couple of things I'd like to highlight in relation to the US election. One of the things that we discussed early on in the year was that we expected the US government to spend a bit of money prior to the election. And that's pretty typical of most governments. Our government here does the same. The government in place has a bit of an advantage relative to the challengers, and they can afford to spend more on the economy, make sure the economy everybody's happy, and that tends to be favorable from a voting perspective. The surprise was that as we're getting closer to the election, which is less than 3 months away now, we haven't seen that increase in spending. And by now we should have seen it, because there's a bit of a lag between when you start spending the money and when you start seeing the effect of it. And so we should have seen it, and it hasn't really started. I have to add up to maybe the last couple of weeks, but like we're talking really kind of short-term data here. And our assumption has been that in this particular election, economic strength has taken a back seat to inflation. And inflation is really the number one topic. I don't know if you've watched the Biden-Trump debate. Remember ages ago when the presidential candidate was still Joe Biden, then it didn't matter what Biden was saying. Trump's answer was immigration and inflation, kind of hammering him on those two issues because they're perceived to be weak points for the Democrats. And inflation is one of them, right? So what happens when you spend more on the economy is that you help economic growth, but you also potentially kickstart inflation. And they've realized that we'd rather have a slightly weaker economy, which we're now seeing with that unemployment number that I've just talked about, but really don't want to see an uptick in inflation, and we want to see inflation coming down. And that's probably why we haven't seen that increase in spending. As it turned out, like it is having an impact on economic strength, but not pushing us in a recession so far. It also hasn't had a terrible impact on markets generally, as you mentioned. The kind of year-to-date and 12-month numbers are still up and positive. The other aspect of the election is, I would say it's fairly likely that we'll see some volatility around election time. That tends to be volatile times, especially when it's an undecided election. And at this stage, it seems a lot more undecided than it was a few months ago.
Yeah.
And so it's very, very hard to predict which way it will go. And I'm not talking about the election. I'm talking about the market's reaction. Let's say Trump gets in. Are the market's going to like that or not like that? Or Kamala Harris gets in. What will be the market reaction? I will say, as a reminder, that in 2016, when Trump got in and it was a massive surprise, you saw a big market reaction because that wasn't priced in. What's priced in was Hillary Clinton being president.
Yeah.
But the reaction was the opposite of what everybody expected. Everybody thought that it would be a negative. It turned out to have been a large positive. So be very careful about interpreting and extrapolating and predicting that sort of market reaction. But what's probably easier to predict is that we'll have some volatility one way or the other. But that, again, we expect that to be relatively short term. In terms of, and we still have more work to do on that, But when we start looking at the policies of each candidate from an economics perspective, it's maybe a bit surprising, but there's actually not that much difference between them on the economic front. And I'll just highlight two things. Number one is they're both big spenders. And by that, I mean, there's no more fiscal conservatives in this election. Trump is a big spender. He's taken a break from, the Republican tradition of being more conservative with the budget and aiming for a budget surplus. Like, that's a gone by era. And the Democrats have always been a bit more keen to spend money. So from a deficit perspective, there's not really a big difference between the two. The other one being trade policy, which Trump really broke with tradition there in initiating the trade war with China. But the interesting bit is that Biden in 4 years hasn't reversed any of that, hasn't signed any free trade agreement with any country at all in 3.5 years in office. And it's really kind of the more protectionist policies have now become bipartisan, supported by Republicans and Democrats alike. So when you think about what could have a longer term impact on markets, at this stage, we're not seeing really a big difference between the two. I will add that, especially with Trump, it's a bit difficult to know what his policies are going to be. He's less open about that. There's not like an easy document that he says, well, we'll do this, this, and that. But from what we can tell, so hence why I said there's probably a bit more work to be done there and see if there is other issues that could impact markets.
It's interesting because I think, again, it's an election personalities and and egos rather than policy, if that makes any sense. It's not really about those changes. And people, I think, probably would struggle to even know what 2 or 3 different policies of both parties were, because they're not really that interested. It's just sort of, again, from the distance, it's just the fun and games of them two going at each other. And Joe has stepped out and now Kamala comes in and it just continues on. So again, I think people are fascinated by it from that perspective. Is it's everywhere you go because it's a big deal. But then what's the actual real impact of that? It's probably yet to be seen. But I don't think, again, won't put words in your mouth, that we don't need to be super hung up and concerned about that either. We just will roll with it. And neither of them are going to blow up their economy. They're going to probably spend some money and maybe stimulate in different ways, and things will continue to move forwards.
No, that's right. That's right. I think that's right.
How does that link into the Australian, more looking at our own backyard? Again, we sort of just obviously follow on the US very, very regularly. So we do spend a lot of time talking about them, but for good reason. What do you think happens more locally? Again, interest rates, maybe you want to comment on that. Do you think we very much follow suit with the US?
Yeah, so look, I think it's a fair disclaimer. I know we spend a lot of time talking about the US, but especially from a markets perspective, from a central bank policy perspective, it really sets the tone for everything in markets, and hence why we spend a lot of time on it. In terms of interest rates policy, there's an interesting phenomenon since COVID, which I'm not sure I can explain, but it's that Australia seems to be about 6 to 12 months behind the US and following exactly in the same path, but just with a bit of a lag. And maybe I don't know if it's connected, but maybe it's because we were in lockdown for longer. I don't know. So what that means is you kind of wind the clock back to just 2 months ago, at the time where the talk in the US is about reducing rates. The talk in Australia with the RBA is still about increasing rates, right? Because we're still worried that we have an inflation problem here that seems to have been solved in the US and in Europe, but less so in Australia. It seems to be more sticky inflation in Australia. I really think that that's just a lag issue, and that we're literally 6 to 12 months behind, and that we're not disconnected from the global economy. And if we're seeing inflation coming down everywhere else in the world, I expect to see the same here. And we are seeing it happen. It's not happening at the rate that the RBA would have liked to see, but it is happening. And I think fast forward to today, there's much less worry about the RBA having to increase rates. Probably they'll have to maintain rates where they are for a little bit longer, and then probably join the rest of the central banks around the world in cutting rates sometimes next year.
Yeah. Is that sort of the general consensus now? Is that we're just going to hold for a period? And again, we probably felt like it's going to be holding for a while. There's always that little bit of fear, and maybe that gets projected out to keep people on their toes about the potential for a rate rise, but you just need to talk about it. That's probably enough. They don't actually need to pull the trigger on that.
Yeah, and look, you're right. I'm really highlighting the consensus here. I'm not making a prediction of where we see things. As you know, we've discussed this. I don't think anybody has really an edge in consistently and accurately predicting where inflation and interest rates are going to be. Why I think this discussion is useful is I think we have to be ready for different scenarios, right? And it's important to see what's the consensus scenario is, what is kind of priced into markets, and therefore allow us to think on either side of that scenario, what might happen that could surprise markets, right? So if we're talking about a consensus today that interest rates are starting to come down in the US and they're fairly stable in Australia for the time being, then you know what very well could surprise markets on either side is if we have actually inflation that starts ticking up again, which looks like a small probability at this stage, but it's never zero. Or on the other end of it, if we dive into a recession much faster than anticipated. And on the one hand, that would cause the RBA to increase rates. On the other hand, it would cause the RBA to reduce rate much faster, right? So both of those things, all of those three scenarios have to be in front of our eyes. Just got to be aware that the one that's priced in currently is the middle one.
Yeah. And I think, again, it's always like that. I think we're probably just more aware of it than normal because rates have been a bit higher than they have been. But there's always a risk of rates going up or down. We just probably aren't as actually acutely aware or conscious and need to be worried about it where we've been through this period. Everyone's starting to burn a little bit. And I suppose realistically, that's what they want. Like they want people to feel that pressure. They've just had to keep that pressure on a little longer and then that will start to roll off. I suppose, how has that impacted companies? So like looking at some of the stocks that we hold and just the market broadly, reporting has been coming out for a lot in recent weeks. What are the results been like across the board and maybe a couple of specific stories around some of our holdings?
Yeah, sure. It's a bit early days because we're right in the middle of reporting season in Australia. Reporting season happens twice a year. Companies have to report their results to the ASX, and that happens in February and August. So we're like right in the thick of it. Typically, what we'll do is at our next investment committee, we'll have a bit of time to look at all those results, look at every stock in isolation, see if kind of the thesis for us holding it has changed based on the new information. And usually, can do a little bit of rebalancing, a few buys and sells, etc. And so we're really in the thick of it. I can talk to probably a couple of companies that have already reported that we've had time to look at. They actually both happen to be in the healthcare sector. It's not completely by chance. It is the sector that in our portfolio we are the most overweight relative to the index. And so I guess to some extent it is important that those companies do well for us. The two that I wanted to highlight is ResMed and CSL. So ResMed, if you recall, it's a company that we've held in the Britton portfolios since we started collaborating together and launching those portfolios. And it was a company that we liked. It's a good, really high quality Australian company that has a very steady growth of earnings. And as is usually trading at a quite expensive valuation, which reflects that quality, right? Like it's a high quality company, you have to pay a bit more for it. We thought that it was worth having in the portfolio. What happened at some point, I think about a year ago, maybe a bit less than that, timeline gets a bit confused lately.
Time flies.
Is the emergence of what's called GLP-1 drugs. They are drugs that were originally intended for refresh my memory.
Diabetic
drugs, exactly. Yeah. Diabetic drugs, and that were found to have very interesting side effects in lost weight. And they were kind of going to repurposed for a dual purpose, not just for diabetics, but people with obesity as well. And this was kind of a big craze, especially in America and in those 2 or 3 pharma companies that have those drugs. But then immediately the market started extrapolating to, if this is going to be such a revolutionary drug, what else is it going to impact? And ResMed specializes in sleep apnea products. Now, there is some correlation between being obese and having sleep apnea issues. And so the conclusion was, if there are in the future less obese people, there will be less demand for sleep apnea. And the share price of ResMed fell by about 30% or so, right? It was like lost a third of its value. And look, we looked at that and with our uneducated eyes at a few medical research papers that have been written on the subject. The link between the two is not that clear between obesity and sleep apnea. There is some link, but it doesn't seem to be anywhere near that magnitude. And so we looked at it and said, look, it seems to have been an exaggeration on the market reaction, which, as we discussed earlier, is also what created opportunities. And we essentially doubled down on ResMed. And since then, the price of the ResMed has been gradually climbing back up. And as of today, recovered all of its loss and is back to where we bought it more than a year ago at a price that we find attractive and that we're happy to hold it at, right? The latest result was really just another confirmation of that. to see that actually earnings haven't been impacted at all by the GLP-1 drugs. And in fact, earnings continue to grow. Now, ResMed itself has an interesting theory, which is not only is it not going to negatively impact their sales, it's actually going to increase their sales, because they say like there's a lot of opportunity for dual people who will take those drugs will actually be more aware of the sleep apnea issues. And there's like an ability to combine the two treatments, basically. Anyway, that's yet to be determined. But as far as we're concerned, it's nice to see just another half-yearly result, seeing that there was no impact, that the growth trajectory is really not impacted and on track.
I think the really important part that we find from that is the process part of it. So you make a purchase initially, an investment that you think is with the thesis there, it gets challenged, you reassess that. Now, in this case, you reassess it and you invest further because you're very confident that this is just it's not real, like it's an overreaction to an event. Alternatively, it could have been you reassess it and you go, yeah, and we think this could get worse, and maybe you actually pull out of that position, or maybe there's the hedging of that and just not making any alteration. And I think that those decisions are happening all the time. There's movements in prices and valuations of our assets all the time. That's an example where you go back through and you're really comfortable and very confident in what the original thesis was. So you put some more into it and you go again. Sometimes you have to accept the fact that maybe that is actually maybe not terminal for that company, but it is going to be a long-term impact. And that's where the really difficult part for people that don't have a buffer of information is to actually pull the pin on something and move elsewhere. And I think that's where, again, this process with the SMA and getting Investcent's expertise on it, we can wade through that and make these really good decisions on a stock specific level, as well as looking at the broader market. And I think that's where a lot of people go wrong. It gets emotional when you see those drops. So you just got to step back from the emotion.
Yeah, I'll add another scenario to that. So you say, like there's the other scenario is like we do our work, there's an overreaction to something. We look at it, or at least like a price drop, we look at it and we make a determination either way. And then it turns out that we're wrong, right? Like as in like I highlighted a success story with ResMed. It could have gone another way, which is why I think it is important to always emphasize that we're doing that across a diversified portfolio. And there's 30 odd stocks in that portfolio, and you apply that process with discipline across enough stocks that you can get one or two wrong, but you're not impacting the overall return of it. And on average, it works. And so I thought it was important to mention that, because next year we could be sitting there and discussing one that wasn't as successful. But what's important is the process, the discipline, and more importantly, the diversification.
Yeah, that's it. The process is what helps us to eliminate just complete luck. Like otherwise, you're just putting it all in there and it's just a luck process. And sometimes people get lucky, but on average, if you have good process, then you will do much better longer term. So what was the other healthcare stock? I think it might have been CSL. Is that the other one you wanted to touch on? Yeah,
that's right. So CSL, always worth discussing. It's one of the largest position, if not the largest position in the portfolio at the moment. And look, the story with CSL is that it was, always been for many years now, a really high quality and also a company growing its earnings quite fast. In Australia, it's really an Australian champion that exported its business to the US very successfully. And it's worth noting that although it's growing earnings very fast, it's not distributing a lot of dividends. It's not a dividend stock. It's a very low dividend stock, but it's reinvesting earnings in a profitable way. What happened with they saw fairly large disruptions because of COVID, and it's taken them a few years to recover from that. And at various points in time, they may have a little bit behind that recovery relative to what the market expected. These has usually been opportunities for us to add to it. So we haven't added to it in as a meaningful way as we've done with ResMed, but it's more on kind of like occasional rebalancing. If it happens to be at a period of time where the share price is a little bit weak, we're happy to kind of rebalance, increase weighting a little bit. The latest result was very much in line with what we were talking about earlier in terms of expectations versus reality. If you look at the result in isolation, it was actually a pretty good result. The recovery in the main business of CSL, which is plasma collection, is now definitely on track. Their vaccine business, which is another big component of it, is doing okay. There's one disappointment in their third largest business, which is, I think, an iron supplement business, which has done okay, but not as well as expected. All in all, it was a good result, but it was less than what the market expected. And you saw kind of the share price react a little bit negatively to that. Not hugely negative. I think it was down a few percentage points, And as often the case with CSL, it kind of in the next few days has recovered it. So for us, it was more of that's a bit of a nothing story, which is good. Like, we're happy with that, right?
Boring's fantastic.
Yeah,
I think
exactly.
it's the interesting part with that whole assessment is that just because something's growing and doing well doesn't mean that the share price will reflect that, especially in the short term. Like, short-term reactions to that is fascinating. And we sort of talked a couple of weeks ago about how not just meeting expectations, but completely blowing out those and being so far above them is now almost the expectation, which is, again, there's probably a few functions. Maybe the projections are being a little bit more conservative to make sure they certainly don't miss expectation, but also people's expectation that they will exceed expectations. Again, it's a little bit of a complex thing, but it's really important to understand that.
That's right. It's like the second derivative of, their expectations on expectations, basically.
Yeah.
But yeah, look, what the common points between ResMed and CSL on that topic of expectations is it can be a bit difficult to, how do you determine what's priced in? Where are the market expectations into a stock? And probably the most useful kind of fundamental analysis of that is the valuation, right? Like, if it's a fairly high valuation, it means a lot of good news is priced in, a lot of expectations of earnings growth and et cetera. Now, both CSL and ResMed remain expensive stocks in absolute term in comparison to most other stocks on the ASX 300, but relative to their own history, relative to where the kind of multiples that they've been trading at in the past, they're actually not that expensive, right? Like, they're kind of much lower than their average valuation, and which is why we continue to be happy to owning them at these levels, even though ResMed has recovered and even though CSL is trading in kind of the upper range of where it's been trading for the last 5 years. We think that the valuation is still attractive for its. That doesn't mean there's no risk there. And obviously there are some expectations. Obviously an earnings miss would translate into a share price drop, but kind of over the long term, we're happy to own them specifically for those reasons, because we think the expectations built into them is not too high.
I think it's a really important note is that sometimes it can be cases where the expectations built in are just excessive, like there would be almost the 1% chance they actually meet that, and sometimes they do get met. But based on the probabilities, which is really all you're doing is assessing the numbers and looking at the chances and probabilities based upon history. Again, it can be quite fingernail deep for some people. That's why there's so many layers to that analysis. That's why why you're so important.
Thank you. But a great example of another healthcare stock that we don't own and that falls into that category is Cochlear. Like, it's really a market darling. It's a great success story, but it's very expensive. Like, its valuation is extremely high. There's a lot of good news priced into that. And you saw it with the result. Like, it was a good result and the share price kind of went nowhere and dropped a little bit, because there's so much expectations already built into it. So what that means in reality is that the future expected return from that stock is not that high.
Awesome. Yeah, I think that's been a good wrap. We get a bit of the macro view, mainly the US, and then a little bit of the Aussie stuff, a couple of stock stories. And then I suppose really looking forward to that next quarter. You'll have had time to wade through the rest of this reporting, and there might be a few more actions and things to follow that. But thank you as always, mate, for jumping on. It's always good. And I know people enjoy it, and you put it into nice, simple terminology so that even I can understand it. So thank you very much.
Thanks very much, Ben. At least I tried it. Thanks for having me again.
Thanks, mate.
Bye.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.